Hello, everybody, and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer, nothing here is investment advice. Do your own due diligence. We bring you the information. You do the research. And today's guest is a contrarian macro strategist with 50 years of experience on Wall Street and the chief macro strategist at Contrarian Macro Advisors. It's David Hunter. Thank you for coming back on the show.
Yeah, hi, Jesse. Great to see you.
Yeah, great to see you as well. I want to get started with a broad question. What are the main themes and trends you're currently watching when it comes to markets and the economy that you think more investors should be paying attention to right now?
That's a big, broad question, but I will say, obviously, short term, we've got the Fed meeting today, and people are expecting them to have no change in rates, but talk pretty favorably about a rate cut in September. They could surprise us and cut rates today by a quarter point. Normally, Powell likes to telegraph that and get the markets prepared for it, so that's why I think it's the probabilities are low that he will cut. But the economy is slowing down. That's part of the theme, is the economy is slowing down decidedly, so that they really should cut now. But whether he does it today or waits till September is not a huge deal. The bond market is responding to the weaker economy and the fact that inflation is continuing to slow. So the bond market's doing the rate cutting. It really doesn't matter what the Fed does.
So we have seen somewhat of a correction in the broad market. Some are pointing to increased insider selling as one of the catalysts that could mean we're in for a steeper downturn. However, as we speak today, things look like they're bouncing back. Nvidia up over 10% as we speak. It seems that every time we see any sort of small correction in the broad market, all the pundits come out on Twitter and on social media crying, here we go, guys, it's going to crash, everything's going to crash. And then it always seems to recover. I'm wondering what your thoughts are there on the broad market. I know you expected kind of a melt up and an eventual collapse. Where are we when it comes to your targets for the S&P and NASDAQ?
Yeah, I think your comments are spot on in terms of the short term. The market, I call it the stair step process. But the market has to kind of refresh as it goes along, or else it gets overbought, and then you get a bigger correction. So what we've had is these healthy pullbacks. I've said for a long time, we're in a melt up. I think we started the melt up last October, and that we would have short, sharp corrections along the way to kind of refresh and build that wall of worry back up to provide fuel for the further advance. That's what I think this last couple of weeks was about. So, but the market, because it's been almost straight up, it's been a steady, up and away. The investors seem very non-resilient when it comes to any kind of pullbacks. The minutes that, they've been skeptical of the bull market that's been in place since October 2022 anyway. So the minute it starts rolling over, they don't understand why it's up on these stilts. So the minute it starts rolling over, you hear them coming out of the woodwork calling for a crash, calling for, at least a 10% pullback. And maybe that's wishful thinking for a lot of them who missed the rally. I don't think you're going to get those kind of pullbacks, but you can get what we just had was a 5% pullback in the S&P, a little bigger in the NASDAQ. But I think it's over. Yeah, today, you're reversing in a big way. I don't think you're going back. So I have been on Twitter today saying I believe we are just beginning what I call the final parabolic leg to this market. So we've had what I call melt up, which is disproportionate rally, not a normal rally, but something much bigger. We've had that this last several months, and I think the next leg is even steeper. It's what I think will be the final stage, the parabolic stage that carries you into a 42-year secular top. So I think this secular bull market started back in August of 1982. And we've had some cyclical bulls and bears along the way, but I think we're reaching the final stage of a 42-year top or 42-year secular bull market that that ends in a pretty spectacular top here, and then I think the other side of the mountain starts.
Hey guys, just a quick break to hear from today's sponsor, ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. Very interesting. You mentioned the Fed meeting. You mentioned the market is expecting a rate cut in September. How fast do you think the Fed will cut rates when they do make that decision? I'm assuming the first cut's going to be a small one. Do you think they're going to cut as quickly as they raise rates up ahead? How do you think that will impact the broad market? And as a side question, when it comes to the bond market, a lot of investors are sitting in cash right now because short-term treasuries are paying around 5%. That scenario would change as well, depending on how quickly the Fed cuts. So will there come a point when sitting in short-term treasuries, storing your cash in money market accounts is no longer such a viable option?
Yeah, I think that point is now. I have long said that the Fed doesn't set rates. The bond market sets rates, or the bond market determines rates. So the Fed can set the overnight rate. That's what the Fed fund rate is the overnight rate that the banks charge each other to, borrow and lend from each other. That's all they really control is the short rates. The longer rates are controlled by the bond market. The bond market in its aggregate, not any individual, but in its aggregate, the law of large numbers, the bond market's a far better predictor of where we're going, both in rates and in the economy, than I think is the Fed. So all these people that spend all their time thinking, spending all their time wondering, is the Fed going to cut this time or next time? How much are we going to get? I think it's a giant waste of time. The Fed follows the bond market. The Fed doesn't lead the bond market typically. So bonds have already fallen. Bond rates have already fallen. You've taken the 10-year down from 470 a couple months ago to 4. I think today we got to 411. So you've already had a huge cut in rates, and 10 years far more important than the overnight lending rate for banks. And the bonds market setting now way ahead of the Fed. So the Fed's spending its time looking backwards at backward-looking data, and I think they've waited too long. But it doesn't really matter because the bond market's doing the job for them. Going forward, I don't know what they're going to do month to month, but my guess is we could have, as many as 3 or 4 cuts into the end of the year. If they cut today, we could have 4 cuts. If they start September, I think you'll see a September, November, and December cut because the economy is slowing. Because I think the Fed has overstayed its welcome on the tight side. They think they can, as every Fed, every cycle, every time the Fed thinks they can micromanage this thing down to when it's time to cut. And they always wait too long because of the leads and lags. So I think they're doing that again. And the problem this time is that we are a far more leveraged economy, a far more leveraged system than even back in 2008 and 9. And, way beyond anything we've ever seen in history. We've got 320 trillion in global debt. We've got quadrillions in the notional value of derivatives. That's leverage that's off the charts, never been there before. And leverage on the way up can enhance returns, but on the way down, it can really exacerbate things. So that's, if you make a mistake as a Fed and stay too long, we've seen, we saw in 1974, we saw in 1982, we saw in, 2003, we saw in 2008-9, that by waiting too long, we got a harder landing, right? The economy took a big hit in each of those cycles. This time, I think it's going to be even bigger because of that leverage. So, in other words, the policy error of waiting too long gets magnified this time because of that. So, they're trying to tune this thing down to the week and month, and well, we better not go too soon. Meanwhile, under the surface, you're seeing lots of disturbing things that say this economy could decelerate quickly. And so, that's why I have such an extreme view that we go, up into this top, and I've been way ahead of everybody else and way higher in terms of my target. But right behind that, I've said for a long time, we're going to get a global bust, and I define a global bust as something bigger than a normal recession, but not the length of a depression. So it'll be fast. It'll probably be contained within 2025, but it'll be more damaging than 2008-9.
So is there any historic precedent for this bubble bursting and for this downturn that you see? You mentioned the tech wreck, you mentioned the great financial crisis. You said you think this will be more severe. Looking back in history, can you find any precedent and any parallels that you can draw from any other times to give us maybe an idea of how this will get resolved?
There's probably pieces of or glimpses of what I'm talking about in other cycles, but nothing comprehensively looks like this. 1929 certainly was, a fall off a cliff in terms of the market, and then followed by a long depression. We had in 2008-9 probably the closest thing to this. The reason that I think this will pattern a lot like 2008-9, what I say is that the difference is in 2008-9, in October of 2008, commercial paper market froze up, and the if the Fed hadn't reacted quickly or the policymakers hadn't reacted quickly, you would have seen companies like General Electric go under. They depended so much on financing overnight, but they did react just in time. If they hadn't, I think you would have seen a bust in 2008-9. So this one is that point in time, except they don't have the luxury of being able to save it before we go over the cliff. And so it's just a bigger downside in the markets, probably a bigger banking crisis around the world. I think major banks are going to fail, and maybe not so much this time in the U.S. because of what happened in 2008-9. Our banks were forced to get deleveraged, and so they'll be hit hard, but maybe not as hard as they were in 2008-9. Whereas Europe, I think, can get hit much harder. Canada, I think, didn't learn the lessons of 2008. They were in much better shape than we were then, and now they look like we were then. So they could be in trouble. And obviously, their real estate's up on stilts. Australia has a lot of problems because of their real estate, et cetera. So I think it's going to be a worldwide problem, and it'll come to the U.S. The counterparty risk and everything, and the ties in the banking system around the world means we're not going to avoid it in any way. But I just don't think you're going to see quite the comprehensive failure you saw here back in 2008.
You brought up my home country of Canada there, and I have to ask because I'd like to touch on gold here for a moment. Canada has no known gold reserves, apparently nothing on their balance sheet, and we're looking at central banks around the world accumulating gold. First of all, countries with gold on their balance sheet, will that help them absorb the shock of this downturn that's coming up ahead? And how would a country like Canada fare in that scenario with supposedly $0 of gold on the books?
Yeah, I'm not sure it's going to be a huge factor, but certainly if you've got gold on your books, I'm predicting $3,000 gold this year. So it's an appreciating asset on the books, and there aren't too many of those on any of these government books. So it does help to a certain extent, but it's minor, I think. The bigger problem will be down the road. I think gold can go to 20,000 by late this decade, early next. So that's a huge thing for the Russias and the Chinas and the USs who have gold. If you have no gold, like if Canada truly has no gold, it was a foolish thing not to have at least had some reserve there, particularly given what's going to happen to these countries or to the governments. If my forecast comes true, the bust is going to cause massive fiscal and monetary response to the tune of, I just look at the US, but the tune of maybe 20 trillion coming out of the Fed in new money, in QE, et cetera. Um, and proportionally all around the world, that kind of infusion of money that will jumpstart an inflation cycle with a lag. It'll take a year or two, but by the late 20s, you could be looking at in the U.S. 25% inflation by 2029 or 2030. Um, if we're looking at 25% inflation here, you can have similar in Canada, and think of having to finance the deficits that these countries have, the debt that they have. We won't be able to service the debt at those rates. And that debt, now, again, I just look at the U.S., I don't know the numbers in Canada, but the U.S. debt will probably double during the bust, in response to the bust. So you'll have, if we have 20 trillion in new money coming in, it's going to be matched by, maybe not a double, but certainly 20 trillion in fiscal expansion, fiscal debt. So you're not only going to have to finance what you have now, but a lot more than that at rates that are through the roof. There's no equation that can balance that. I don't have any answer for you in terms of how that ends, except very badly. I think we're going to see in the 2030s, not 2030, but sometime in the probably first half of the 2030s, we're going to see governments go belly up. We're going to see basically bankrupt governments and collapse. So it's you know the seeds are sown. I think this has been building for ever since the Great Depression for 80 years or more, cycle to cycle to cycle, and we're now at the end point in that whole thing where we have this Ponzi scheme of debt that's up through the roof, and we just kept financing it. Every cycle required more money, more debt to pull us out of the tailspin, and we're now at the point where there's only one cycle left, and then I think everything unwinds.
And how are you currently viewing the whole narrative concerning BRICS nations versus the West, their seeming desire to de-dollarize? We recently saw frozen Russian assets being given to Ukraine. I believe it was 1.5 or 1.6 billion. Um, we're seeing Russia, China, Iran, India get closer. Putin recently awarding Modi one of the highest honors in Russia, some kind of medal. We're seeing the Chinese military conducting operations with the Belarusian military on the Polish border. There's a whole bunch of these kind of signs that are starting to come up, that seem to, at least if you believe the headlines, show that the BRICS nations are strengthening. And of course, the narrative is always that the West is weakening on these sorts of headlines. I wonder how much of that is hyperbole. How seriously do you take that? And do you think gold will be involved somehow in this whole de-dollarization story?
Yeah, that's a great question. It's the world's a mess. I mean, there's no question. The world is a mess. We've had those alignments for a while. I mean, it's obviously when you get to the point where it looks like a misstep could lead to world war. Then those things come to the forefront. But I mean, Iran and Russia and China, Iran being aligned is not a surprise. They've been aligned for quite some time. Um, India is kind of a wild card. I don't really think they're aligning with that bloc. I think they're maybe playing their cards a little bit both ways, as well they probably should. Um, but yeah, in terms of, I mean, we've obviously, and it didn't start with Biden's regime, but his regime's done, made a mess of everything. But this idea that we can, instead of fighting the wars, we can have proxies fighting the wars, and instead of, um, you know, shooting people, we're going to use sanctions. That thing's been an absolute failure and has led to some of this other stuff. Saudi Arabia, I think, is wild card in all of this as well. I do have some hope that if we get past the Biden administration and we get a Trump administration, that some of that can be repaired. It's not clear who's what. I mean, Russia is an aggressor. It's naive to think that this is just as some people believe. The Biden administration, trying to fuel this thing and cover up some other things, etc. I think Russia's been an aggressor, but I also think we've poked the bear. There's been a lot of mismanagement, I think, in this. So whether Trump can end it like he thinks he can, we'll see. But I do think there were places along the way where we could have maybe seen some peace agreements and avoided hundreds of thousands of soldiers being killed. I just don't think it's been executed well. But we do have a New World Order agenda out there. I think in this country, there are a lot of politicians that are helping fuel that. Certainly the left would love to see a one world government. There's clear agenda there, so they're trying to hurt us. Even though they're supposed to be our country and managing our country, they're doing things that I think are greasing the skids for that. So this all fits into that too, as I think. I've got my own theories about the whole thing going back to 9/11. I think we were baited into Al Qaeda. There's some reason to believe that Al Zawahiri was supposedly number two Al Qaeda guy was supposedly a KGB agent. If you go back in the archives, so they may have been doing the dirty work for Russia. Being able to be a surrogate without us thinking it's Russia. I think we were baited into going over into the Middle East. They knew we'd react, and then we spent decades drawing down our military and both hardware and soldiers and are a shadow of what we were in terms of the military got drawn down, and then we pull out of Afghanistan. Soon after Afghanistan, Ukraine happens. It's just another way to draw us down. I mean, we're pouring money into there like crazy and not pouring into our own military. So I believe it's basically the communists using a strategy to draw us down so that we become a paper tiger. I'm not a military expert, so I can't tell you whether there's a good answer contrary to that in terms of how strong we still are. But I do feel that may be some of what went on, if not a lot of it. And I just think we need new leadership in this country for sure. It's the people that have been at the forefront here for a while do not have our interests at heart, in my opinion. So
politicians rarely do. I want to get into a few commodities here with you, starting with oil, and maybe we could tie this into some of the geopolitical turmoil that's going on. We are seeing conflict escalate in the Middle East. We're seeing bombings, we're seeing civilians killed, we're seeing what only appears to be continued escalation from all sides, and it doesn't look like things are going to be slowing down, but rather ramping up. Does this have a real impact on the oil markets, in your view, on potential disruption of supply due to a lot of these countries have large oil reserves? Is oil's role geopolitically overstated? Because a lot of people think that if any sort of massive geopolitical event happens, oil's going to the moon. How do you think about oil and its relation to geopolitics and global conflict?
Yeah, let me start with my forecast because I think that'll help clarify where I'm coming from. I have been on the right side of this thing compared to most oil analysts, I think, out there for quite some time here. From that ramp up when it went to 130 when Russia entered Ukraine, I've been bearish ever since, and have been talking about it going back first up in the 120s. I was saying it could get back to 85. I missed the run up. I'm not claiming I saw the run up, but since then I've been pretty right. It went down to 85, and then I said I think it can go into the 60s. Got down into the 60s, and I've been saying ever since it'll be up and down, but I think ultimately we're going to 60 probably this year, and 30 in the bust. So next year, because of a global bust, demand's going to go through the floor, and I think you can get down to 30 if if Trump is the president and his policies towards oil, that just helps grease the skids towards that anyway. So that's my kind of the framework from which I operate, and then I do believe that oil will become, oil's not going away. This idea that we're, climate change and the green agenda, et cetera, is going to push oil off the landscape. Not in this decade for sure, and probably not next. I believe oil can get to $500 a barrel, excuse me, by the end of the decade. So part of that is that ramping up of the big money, monetary and fiscal ramp up in response to the bust, with a lag, is going to generate a huge inflation cycle, and particularly industrial driven, and that ramps up demand for oil. And there's no, you're not going to be able to ramp up supply to match that because, oil's not being searched for in the way it had been. And so it takes a while to, develop new oil reserves and be able to match the demand. They won't be able to match it this decade. So that means demand's going to far outstrip supply, and it's going to drive oil up. That to me is the driving forces for oil. You add in any politics, and it can tweak it around the edges, but I think the driving force is really all this macro.
And do you follow the uranium space at all? I'm wondering what your thoughts are on that sector. Uranium stocks have been selling off to the point where people are literally getting emotional on Twitter, proclaiming the uranium thesis is over. The top is in. Do you watch that space? And if so, what are your thoughts on the recent correction in the sector?
Yeah, there's two areas I've kind of stayed away from, um, and I've been glad that I stayed away from them. One is uranium, and the other is Bitcoin. So I beg off on both because I don't follow them. My only comment on uranium would be, it would seem, given geopolitics, given the whole landscape energy wise, it would, and the we're starting to move towards more favorability towards nuclear again. Certainly the smaller nuclear um, plants make some sense. So it would seem that demand's going to be good next cycle, and I think most commodities are going to go through the roof next cycle. So you know, with the caveat that I really don't follow it, I would say longer term, I would think uranium should, do what the bulls thought it was going to do, but it's just taking time. And, shorter term, you've got pretty short leash here in terms of short time frame here anyway, since a bust is probably a next year story. So, but I think beyond the bust, I would, without having a lot of knowledge, I would think uranium would move up in price pretty good. Um, but yeah, I don't really follow it.
Yeah, some great comments there on focusing on the long term, because I think the thesis can always take longer to play out than people think it's going to. People get caught up in short term price action. As an oil investor, I hope oil goes to $30 a barrel. That would be fantastic buying opportunity, because again, I'm focused on the long game. I want to get your thoughts on copper here, because we saw a run up to $5 around, a little over. And now it's corrected quite rapidly to around the $4 level. As we speak today, it is ticking up a little bit. Is this a recessionary indicator in your view, or just a natural correction after it ran up?
I mean, certainly copper, Dr. Copper is a good economic indicator. I view this as, part of it was fueled by the fact that the investors out there got nervous that the cycle's ending, that, the stock market's top is in, the economy's getting weaker. So they kind of put two and two together and got six and took copper down fast. I view it as a correction in the move. I think, people forget. I think copper was 340 or 360, back in October. So, you move from 360 to five, back to four. I view it as, probably didn't need to get quite this steep, but like I said, because of the emotions in the market, it did. I have a $6 target. I've had a $6 target on it for a while, and looked pretty good when it was five on its way. I think this just was kind of a detour, and I still think we'll see $6 probably before the end of this year.
Do you follow agriculture at all? Fertilizers, wheat, soy, etc. How do you think that sector is doing? That's another sector that's been beaten down, particularly a lot of the bigger fertilizer stocks, and nobody seems to be paying attention. I'm wondering what your thoughts are there.
I don't have any real thoughts about it between here and the top because I think the top could happen before the election. So it doesn't give you much time. It might play. I don't follow it closely, so I don't know. I actually don't know where, I haven't looked at them in a long time. Post election, I would think they fit into the whole commodity story. They should do very well. By the way, I think natural gas will go through the roof, and that certainly has been it's been flat on its back for a while. So again, into the bust, I'm not worried about any of that because I don't think there's enough time. But you get out, and the dynamics are going to play for a commodity cycle are going to be, I call it commodity super cycle. People talking about that now have no idea what a true super cycle in commodities is going to look like. It's going to be unbelievable, unlike any we've ever had. And I would think fertilizers, natural gas, et cetera, will play in that. In terms of the ags themselves, like wheat and corn, when I look at those charts, I mean they're very deflationary looking, and I think they probably do go lower into quite a bit lower into next year's. Even though they're not economic per se, they tend to follow the cycle, and I think they'll be weaker into the bust next year. And then the other side of the bust, I think ags will be a big part of the commodity story, and we'll see all-time highs, much higher highs than we've ever had in corn, wheat, oats. Probably, I don't follow livestock as much, but I think when you look at where inflation's probably going by the end of the decade, and it's going to be across the board, I feel sorry for the consumer. Just like I don't know how the equation balances for the government in terms of servicing their debt. I don't know how the equation is going to balance for the consumer because I'm calling for an 80% bear market next year, or could start before the end of this year, but an 80% bear market between the end of the bull market and the end of next year. 80%. So that takes a pretty, consumers are going to take a huge hit to their wealth on that side. I think home prices in the States can drop 30 to 40% during the bust. That's another big hit to their equity. And then they got to come out the other side. And the first couple of years, probably inflation will stay pretty tame, at least the first year, because you're coming out of deflation. I think you'll have deflation next year. But by 2027 or 8, you're going to be moving well into high single digits toward double digits. And then, as I say, ramp up into 20 or 25% inflation pretty fast. So, consumers just not going to have the wherewithal, I think, to deal with that. Incomes will rise, but I don't think, as always, they'll lag the inflation and they won't keep up. It'll be, you'll get cost of adjustments in them. I was there in the 80s. I was a professional investor back in the late 70s, early 80s. And we'll see a similar pattern where eventually you'll see built-in inflation adjusters to income, et cetera. But that'll come very late in the decade, I think, and they're going to be digging out for, I think, the whole cycle.
So do you think this sort of rampant inflation presents any sort of risk of civil unrest occurring in, both places like the United States, so-called developed countries, as well as emerging economies?
Well, I think you look at what we've had in the last 3 or 4 years in terms of so-called civil unrest. The Antifa over here. You look at what just happened in Venezuela. With a stolen election. I think our election was stolen in 2020. As much as some people may not believe that, there's a lot of evidence. So, I mean, we've started that process. The response here has been pretty tame, and I would guess it's going to continue to be controlled up through this decade. I think the real unrest, the real unknown in terms of what happens, is in the worldwide collapse I see, whether it's 2033, 34, 35, I don't know exactly when, but I think during that, I mean, people are going to be, fighting for survival. There's, as I put it, and this is just in the States, but I think it'll apply across the globe. You know, I think I can draw a scenario. Again, it's total seat of the pants. I don't know if it'll happen, but based on putting all these pieces together, is what could happen. You could have 50% plus unemployment in this country, no welfare system, no unemployment benefits, no Medicare, Medicaid, or at least very limited, and Social Security will be pretty bankrupt. So, basically, no government support and people having no income. I mean, what comes of that? You know, you'll see some bartering, you'll see some of that, but basically, people are going to be trying to survive, and that means dog eat dog. I hope I'm dead wrong. It's what I fear, but again, it's still a ways out. So I tell people there's going to be enough happening this decade. Focus on getting your house in order this decade. Take advantage of what you can in the markets this decade, and try not to lose sleep over something 10 years out.
Yeah, well, let's talk about getting your house in order. What do you think is the best way for people to protect themselves financially, potentially physically as well, if you're seeing this sort of societal collapse coming up ahead? Is, obviously the typical sound money gold bug advice is just stack as much gold as silver as you can, get out of the corrupt fiat system, and you'll be doing better than 99% of the population. Do you also advocate holding physical bullion in preparation for this sort of collapse? And what are the other things that you think people should focus on in terms of getting their house in order?
Yeah, so as a macro strategist, I have to stay away from giving any advice or providing any recommendations. So what I can do is use my forecast to kind of give a broad framework and people can probably read between the lines and figure out from there. But they've got to figure it out for themselves. Um, in the bust. So people get confused because I talk about this collapse in the 2030s. There's a bust next year. It doesn't mean the whole system's going bust. It just means it's going to be bigger than anything we've seen post World War II. I think biggest financial crisis maybe in history, but we come back from it because of the printing press. The problem in the 2030s is because you'll have hyperinflation. The printing press is unoperable. You can't use it. If you print more money, you're going to get the Weimar Republic. So basically, printing press is taken off the table in the 2030s. That's why you collapse. But because we're heading towards a deflationary global bust next year, in my opinion, that means you have almost infinite ability to print money and get yourself out of that, and that's what they'll do. So as a result, you've got to focus on next year, but not the 30s. So when I give this forecast, it's about what's coming right in front of us. Not because people get mixed up. They hear bust and they think I'm talking 2030s, or they hear collapse and they think I'm talking next year. Next year's the bust. So my view is, from a forecast standpoint, there are going to be a couple assets that will buck the trend and hold up against the falling asset situation that you have. Like I said, the stock market I expect to drop 80% peak to trough. Corporate bonds, particularly junk bonds, I think are going to get hit very hard. Could lose more than half their value. Higher quality corporate bonds are going to probably fall, but not fall nearly as hard. And the only things that I think will hold up and not fall are treasuries, and treasuries of all maturities from T-bills out to the long bond. I think because rates are going to fall through the roof, fall through the floor. I'm forecasting a 10-year to 2.5% this year during the meltdown. Then they could back up some for one reason or another. Fed might react to the strong stock market and raise rates, or just a correction in bonds, whatever. But then during the bust, I think rates can fall. The 10-year can fall to zero or below. Short rates can fall to negative territory. 30-year probably can fall to a half or a quarter. So you've got obviously appreciation in bonds if that happens, in treasuries, in government bonds. You will have a big premium. People will run to the treasuries because of the government guarantee. And because of the printing press, our governments are not in trouble this time, or at least the U.S. government is not. There's no default coming in the bust because they'll just print more money. So treasuries are the one thing that I think will hold up during the bust, and actually appreciate probably in certainly the longer maturities. Um, the dollar, I'm calling for a U.S. dollar, the DXY, to fall to 80 in the next 9 months sometime. So, we're at 104, just dropped below 104 today. That's a big drop from 104 to 80. But I think most of that happens before the bust. Some might happen in the first few months of the bust. But somewhere during the bust, when it starts getting pretty rough, I think the world is going to run to the dollar as they always do as the flight safety trade. So I think the dollar gets bid back up. So if I'm right that it goes to 80, I also think it can go from 80 back to 120 or above. So during the bust, I think, and again, people have to be careful. If it's still falling, don't say, well, the bust started, I'm buying, dollar. The dollar may continue to fall in the first few months of the bust. I'm not sure. But from wherever it bottoms, I think you'll have a big run in the dollar at least through much of the bust, through the latter half of the bust at least, and probably more than that. Um, so that again is another, maybe the other asset that can hold up. And then in this country, FDIC insured um, savings and bank accounts up to the $250,000 limit, I think are safe because they have that printing press and they will fund the FDIC to whatever is necessary to protect that. Money market funds is a little trickier. Last, in 2008-9, they had the, don't break the buck policy where it stayed at $1. And so you didn't lose in the money markets once they inserted that policy. I would suspect they'll do that again because they have the printing press. But it's not a given. It's not something we have right now. So, but that's so those things probably protect you. Overseas, it's harder for me to say. It really depends on the government policies elsewhere.
Well, thank you so much, David. This has been a fantastic conversation. Greatly enjoyed it. I know the audience will as well. Tell us about your newsletter, Contrarian Value Advisor, how people can subscribe and what it is you do there.
Yeah, can I make one more comment? We kind of skipped over it, but I think gold and silver. Gold's been consolidating at a high level since April, and silver's been consolidating since mid-May. I think that consolidation ends now, so is ending right now. I think we begin the next leg up. I have a target of 75 for silver this year. Could spill into the first quarter. Doesn't have to be there this year, but before the bust anyway. And gold, I think, can get to 3,000. I think my 3,000 target, it may be conservative. So those are, I think, important to know. And I think the miners that have been so frustrating to investors will finally get the bid. If you move up that much in the metals, you're going to see the miners play along very well. So I just wanted to get that in because I do think that's a big story here in the second half of the year.
Absolutely. Tell us about the newsletter, Contrarian Value Advisor.
Sure. So people, I'm on Twitter every day. So if people want to find me, my handle is at Dave H. Contrarian. Make sure you have that right because there are fake accounts out there that change a letter in Contrarian or something else. So at Dave H. Contrarian, I've got 204,000 followers. So if you go there and you don't see 204,000 followers, you see 1,000 followers or something. That's one of the fake accounts. But I'm on there every day answering questions, answering to critics, what have you, blocking the trolls. um, and then the other way I communicate is through an investment letter. I've got a macro letter that I put out quarterly. It is for a cost, so I tell people you can find out about it, get information on it if you direct message me on Twitter. So most people know how to direct message, but if you go to my profile, there's a little envelope icon at the top of the profile where you just click on that, and you could send direct messages to people that way. So if you direct message me and say you're interested in the letter, I will provide you details in terms of when it comes out, the cost, what it contains, and you can decide whether you're interested or not.
Great. Well, I'll put a link in the description below to your Twitter so people can avoid the spam accounts. Dave, it's been a fantastic conversation once again. Really appreciate you coming on and sharing your knowledge with the audience.
You're welcome, Jesse. Thanks for having me on.
And thank you for joining us today. As a reminder, this episode is brought to you by ARC Silver Gold Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.